in the last segment is you said, hey, Chris, we're a very data-driven organization. Some people right now are questioning the data that you're utilizing to make these decisions. And what I mean specifically, I'm sure you saw this, but ARC's Kathy Wood came out with an open letter to the Fed saying you guys are risking an economic bust, suggesting you're looking at laggard data, meaning the CPI information and unemployment, rather than forward data, which is more of the markets and the commodities. I think a lot of people would probably say she has a point. What say you?
Yeah, I mean, I think the Fed is open to some criticism on where we are right now. I mean, we're a human organization, Chris, and what I would say, especially trying to read real-time conditions, is more art than science, or at least more art than science than we would like to, than we wish it was the case. We gather, I would argue, probably as much information as is kind of humanly possible, but kind of really getting that, that absolute current condition exactly right. I don't, if anyone's doing that right now, I'd love a phone call. So,
Me too.
I think it's fair to critique what our decisions have been. I think it's I would say first, we're clearly looking at the same commodity and market kinds of information that the editorialist was. What I would say is I don't think that we're probably in agreement on how much weight some of those things should necessarily have. Like, we can't just look at commodity markets. Remember, we have to think about both inflation and employment markets. We are also looking at, the unfortunate thing about interest rates and about monetary policy is interest rates is really kind of this Thor's hammer, and you want to try to wield it with some prudence. And I think we've acknowledged that we probably didn't act fast enough, but it was because a lot of the things that we expected to happen, if you go back maybe 18 months ago, when the vaccine was coming, we did see a high price environment, a high inflation environment. But at the time, I think the Fed and lots of other organizations really expected some of the problems that created the inflation to start easing. We expected more people to return to work. We expected supply chains to go back. We expected the rush into goods purchasing. So when the pandemic hit, one of the reasons for inflation is that everybody started buying more goods and fewer services. That's one of the reasons why the price of goods really went up, because there was a much stronger push in, kind of helped by the stimulus as well. When the vaccine came around, we expected a lot of those things to start shifting back to more normal patterns. What we didn't know is that there would be these continued surges of COVID, the supply chains not repairing as we expected. So, when we finally decided that we had to use Thor's hammer, that's why you've seen the more aggressive moves that you've seen the last 2 or 3 FOMC meetings. So we're trying, to use that in a judicious way so we can try to get prices more back in control. It's, again, we're in kind of uncharted territory in some respects, because the pandemic has created an environment that I would say is really without precedent in our lifetime. So we, just like the Great Recession really created the opportunity for learning, I guess I would say, so is the pandemic. And I think we're on a good path right now. We aren't perfect by a long shot, but we are really doing the best we can for the American people.
Yeah, I think, you guys maybe are a little bit behind the curve. And so if you guys can pull off this soft landing, I mean, kudos to you to sort of thread that needle. If you're just joining us, Ron Wirtz, he's the Regional Outreach Director for the Federal Reserve Bank of Minneapolis, just having a fantastic conversation. He's going to join us again next week, and hope we can do this on an ongoing basis. You mentioned this as well, Ron, that Chairman Powell says, look, we're going to do whatever we have to do to get back to this 2% inflation rate. Why 2%? Like, it seems like an arbitrary number.
Yeah, that's a great question, Chris. All of you have been great questions. I've really enjoyed this conversation. So 2%, I don't want to call it arbitrary, but what you want to think about is enough inflation to not be deflation. And the reason we picked 2% is partly because we really want to try to avoid deflation. Now, we are clearly not in an environment that's close to that, but if you go back to the basically 2010 to 2020, before the pandemic, we had a very, very low inflation rate, roughly not even up to our target of 2%, generally hid, around 1.5, 1.8%. You want to be careful of ever going below zero and have deflation like you've seen in Japan, because basically there's also a psychological component to that if, as a consumer or as a business, if I'm expecting prices to go down, that can kind of have a reinforcing negative cycle to it, where people decide that they're not going to invest because they're expecting future prices to go down more. And there's more to it than that, but we basically set 2% as far enough away from zero, but low enough that people can sustain that kind of and absorb that kind of inflation. And again, it's actually a target. It's not a ceiling. It's not a floor. So if it's a little bit below, we can kind of tolerate it. If it's a little bit above, we can tolerate it. It's just kind of a general benchmark.
Thank you for that. And I do want to maybe come back to that when we have you back and just talk about, hey, when does Chairman Powell finally say, okay, we're going in the right direction enough, we can stop with the raises. But I want to get to this because I think this is one of the variables. We've got about 2.5, 3 minutes here for this. So if you want to dive into the details, that would be great. Is that I think this is a variable that we've never had before, that if you listen to like a Ray Dalio or people in that stature about what could be taking place as far as a potential recession and things like that, and that is quantitative easing. So, quantitative tightening. How would you explain quantitative tightening to a layperson like myself, and what is that going to mean from an economic standpoint? Is that going to tip us into a recession, or where are you at with that?
Right. Okay. So I don't know that I can do it real quickly, but I will try. So quantitative easing, I mentioned earlier in the program.
And I apologize, Ron. I don't mean to cut you off, sir. I meant quantitative tightening. Because right now we're in the quantitative tightening phase, correct?
Correct.
So
right.
It's the first time we've ever had the QT before. So what is that, and what does it mean for a person listening right now?
Right. Well, it's related to quantitative easing. And the easing, I mentioned earlier that we have a very large balance sheet. Okay. So basically we're out there buying securities, buying government bonds and other things to keep interest rates low. So what we were doing when the more mature ones were coming to maturity, then we would just buy more. And basically quantitative easing means we're letting those bonds and other securities essentially mature, and we're not buying more. So that will automatically reduce our balance sheet, which is a tightening factor. So there's less money in the economy. Now, whether or not the Fed continues in any kind of aggressive sense, having higher interest rates and quantitative tightening, should kind of have compounding effects. Right now, what I would say is as you've been noting, the CPI figures are still quite high. So it's clearly not overdoing it yet. And we're paying an awful lot of attention to where that pivot point is coming. We clearly haven't found it yet. And I think both measures with both of them, I think the Fed has some options for actually kind of easing back on that Thor's hammer that I talked about when we start feeling that monetary policy is starting to have some impact on prices. Does that help?
It does. I guess my understanding too is you guys have been buying some of this stuff back, which is obviously decreasing the liquidity in the marketplace, which can pose some challenges in some different arenas. But again, just due to lack of time, let's dive more into that. I think we'll talk more about too, just the overall inflation situation and more specifically within our community. We'd love to have you back on a regular basis, Ron. This is just, at least I hope our audience has enjoyed it. I've loved the conversation. So thank you very, very much, sir.
I really appreciate the opportunity to talk with you. It was a great interview. I appreciate your expertise in this, and I hope your listeners enjoyed it.
Man, you have no idea how much that just warmed my heart to hear you say that I've got some even remote level of expertise in this, considering we're talking about monetary policy and the Fed, knowing your experiences. That was a huge, huge compliment, a great way to take me into the weekend. So thank you very, very much for that, sir.
All right. I look forward to talking with you again, Chris.
Me too. Again, Ron Wirtz.